everybody, and thanks for coming. And in this session, we are going to have three interesting presentations and discussion on cryptocurrency derivatives and cryptocurrency investors. And I'm the first presenter. The second presenter is Nicholas, and third is Jefferson. Each one of us will spend 10 minutes for discussion and presentation. So we expect that each speaker will spend 7 minutes for presentation and will spend 3 minutes for discussion. So I'm going to start my presentation. My name is Donghua Shin. I'm an assistant professor of finance at UNC Kinan Flagler Business School. And today I'm going to present my paper, The Impact of Derivatives on Cash Markets, Evidence from Introduction of Bitcoin Futures Contract. This is a joint work with Patrick Augustine at McGill University and Alexei Rubtsov at Global Risk Institute. So what is this paper about? In this paper, I revisit the long-standing question, how does the introduction of derivatives impact spot or cash markets? Without frictions, old wisdom says derivatives are redundant and therefore there shouldn't be any impact. However, with frictions, impact depends upon relations between derivatives and spot markets. And there have been extensive debates in this literature that is still far from settled. In this paper, I studied the introduction of Bitcoin futures by CBOE and CME in December 2017. And I believe cryptocurrencies provide a unique setting to shed new light on the long-standing question. And I believe studying the impact of regulated cryptocurrency derivatives like Bitcoin futures by CBOE and CME on cash market is important in light of growing cryptocurrency markets as well. So I'd like to start my presentation with a very simple figure that has motivated my research. As you may already know, Bitcoin is traded on multiple cryptocurrency exchanges with multiple fiat currencies. And Makarov and Shor in their paper documented a significant price dispersion across exchanges, meaning although exactly the same cryptocurrencies are traded, their prices are quite different across exchanges. And in this figure, I computed an interesting measure, the average correlation of returns of BTC USD minus average correlation of returns of BTC CCY. So here, CCY in my paper, it refers to fiat currencies excluding USD. And as you can see in this figure, before the announcement of Bitcoin futures, we see any strong trend, right? However, after the announcement of Bitcoin futures introduction, we start to observe an increase in the difference, and also right after the actual implementation, we see even bigger impact, right? So in summary, following the introduction of Bitcoin futures, BTC USD becomes more efficient than BTC CCY. And this simple figure has motivated me to study this phenomenon more rigorously using more sophisticated techniques. And why is this event so unique and useful? First, cryptocurrency market has a very unique trading infrastructure. Identical cryptocurrencies are traded on multiple cryptocurrency exchanges, and this is a very rare feature even in closely related markets. And interestingly, Bitcoin futures are introduced on selective pair of Bitcoin fiat currency pair, meaning it was only introduced on BTC USD and not the others. Therefore, it allows us to use defensive approach to identify the impact of derivatives on cash market. And this event is largely unanticipated. Google search volume index for a keyword Bitcoin futures show that the search volume spikes around December 10, 2017, meaning this was unanticipated and we can consider it as an exogenous event. And why is this so important? There are active regulatory debates about the benefits and detrimental effects of cryptocurrency derivatives and crypto products. And we observe rapid growth in regulated cryptocurrency derivative markets and unregulated cryptocurrency derivative markets. Typically, what I mean by this regulated cryptocurrency derivative markets are the derivatives that are implemented by this big institution like CME and CBOE. So recently, options on Bitcoin futures, Ethereum futures, and micro Bitcoin futures have been introduced. And we will see more and more in the future. And not only that, there are other types of cryptocurrency derivative, which are called unregulated cryptocurrency derivative market. And lately, many cryptocurrency exchanges start to offer various types of derivatives contracts in their own exchanges. And the size of this market is growing rapidly. So currently, the trading volume was about $5.3 trillion, which is even bigger than the spot trading. So in order to identify the effect of the impact of introduction of Bitcoin futures on cash market, I measure various market characteristics of Bitcoin spot markets. This includes synchronicity, the Pearson correlation measure, volatility, efficiency, quality, and liquidity. And I follow standard literature on market microstructure to define and estimate these measures. And I use this simple approach to identify the impact. I use this defensive approach. So the main object of interest is this alpha 1, which is the coefficient for the interaction between treatment and post. Here, treatment is the market characteristic for BTC USD. And control pairs are market characteristic of BTC CCY. And we have this post dummy, which is equal to 1 if the time is after the introduction of futures and 0 otherwise. And this is the main result. This is the coefficient alpha 1. And as you can see, we have positive coefficient for synchronicity measure, meaning correlation coefficient increases more for BTC USD compared to the other after the introduction of futures. And we see in general very positive impact. So volatility decreases more, market quality increases more, price efficiency increases more, and liquidity increases more for BTC USD compared to the other after the introduction of futures. In order to avoid the concern that this is a single event, I also study the impact of Ethereum futures, which was introduced in February 2021, and we see similar result. And this is not just the effect specifically on USD, because we don't find any effect if we compare ETH USD versus ETH CCY around the event date for Bitcoin futures. So let me conclude. Cryptocurrency exchanges, cryptocurrency market provides a unique opportunity to shed new light on this long-standing question, whether the introduction of derivatives increase the efficiency of spot market. Based on my result, I would say yes. Okay, so this is the end of my presentation, and if any of you have questions about my presentations, just feel free to ask.
My question to you, Donghua, is first of all, fascinating work, really, really interesting. Your conclusion that's highlighted in red here is that derivatives do increase the efficiency of spot markets, but at the same time, it's also pretty clear that derivatives have facilitated very large liquidation events, which in turn might have caused some instability in the prices of those cryptocurrencies. So I was curious how you reconciled both views.
Yes. So that is a great question, and I believe that this is related to your research on perpetuals and derivatives on BitMEX, right? And in my paper, I studied this regulated cryptocurrency derivatives market rather than unregulated cryptocurrency derivative market. When I first studied this research, I thought there were not a very big difference, but as I studied this more and more, and also studied this other type of cryptocurrency derivative markets, unregulated ones, I find a big difference. And when you say that the liquidation effect, that is mainly happening, as far as I know, that is mainly happening in this unregulated cryptocurrency derivatives market because of the different nature or different structure of the derivative. For example, perpetual, you can take about like 100 times of leverage and something like that. That make the liquidation effect much more frequent, and sometimes there is a cascading effect. So there could be some market destabilizing mechanism. So although based on my result, I believe that in general, the cryptocurrency market introduction of derivatives have a positive impact on spot market. When we see some new type of cryptocurrency derivative, like like for example perpetual futures in BitMEX and so on, we may have some destabilizing effect of introduction of derivatives as well. So that's the way to reconcile my result with yours, I think.
Thank you.
Thank you very much, and maybe we can now move to Nicolas' presentation.
Hello, my name is Nicolas Christin. I'm a associate professor at Carnegie Mellon University, jointly appointed in the School of Computer Science and in the Department of Engineering and Public Policy. And today I'm going to talk about BitMEX and why it matters to understand cryptocurrency derivative trading. Let's take a walk back. Let's go back to 2010. If you wanted to trade Bitcoins at the time, or Litecoin, you had to go to a spot market exchange, a place where you would exchange Bitcoin for cash, US dollars, Japanese yen, euros maybe, and vice versa. That's the only trade that you could do. Actual cash for a cryptocurrency. A little bit later, in 2012, 2013, and really from 2014, we started seeing slightly more advanced instruments, allowing for margin trading, for instance. The key here was BitMEX. And I will explain why BitMEX was that important, but they were basically the first really large derivative exchange that started in 2014. It was not an immediate hit, but subsequently it got very, very popular to the point that nowadays, 2019, 2020, 2021, there's a lot of platforms that offer similar services, Bitfinex, FTX, Binance, and they all have adopted instruments that very much resemble the payment instruments, the contracts, that BitMEX has popularized as early as 2014. To give you an idea of how much this matters, on this graph, what we show is the aggregate volume of all of those derivative platforms, Binance, Ruby, and others, BitMEX, FTX, between November of 2020 and May of 2021, summer of 2021. And to put things in perspective, to give a little bit of context, you see $176 billion, give or take, per day. Is that big? The answer is yes, it is, because the New York Stock Exchange trades roughly $100 billion per day. Now, granted, this is a really back-of-the-envelope estimate, but that tells you that the order of magnitude of those financial instruments is actually far from negligible. It's actually pretty big. So let's go into BitMEX itself. Here, I'm giving you a diagram of how BitMEX interfaces with customers, and it's a fairly complicated graph. I don't want to go into too many details, but I want you to remember two things from this graph. The first one is that to register an account on BitMEX, all you need is basically an email address. At least until early 2020, that was the case. And BitMEX is open for business for pretty much anybody, but US residents or US people. However, until fairly recently, until 2020, give or take, BitMEX was not really going to great length to ensure that people were really not US persons. In fact, if you wanted to pose as a non-US person, all you needed to get was an IP address not located in the United States, which people do very easily. You just get a VPN and you can bypass this sort of controls. So that's one. The second one is that whenever you open an account on BitMEX, you're immediately assigned one wallet address. And that wallet address, that Bitcoin wallet address, is going to be fixed. It's unique per account. What's more, all of those addresses are so-called vanity addresses. They all start with 3BMEX. So you can fairly easily, you need to do a little bit of filtering, but you can fairly easily identify all of the BitMEX addresses on the Bitcoin blockchain, since they all start with 3BMX. And this is going to be useful in our analysis. BitMEX is or was primarily popular for its perpetual futures contract. It's a little bit of a complicated contract to explain, so instead of diving very deep in the details of this contract, I will simply give you the highlights. It's a contract where you can go long or you can go short. And if you decide to go long, you need to find a counterparty to go short. Going long means that you're betting that Bitcoin is going to appreciate. Going short means that you're betting that the value of Bitcoin is going to decrease over time. And it's a zero-sum game. So if Alice says, let's say Alice enters 50,000 contracts, she needs to find counterparties that are going to match her positions. So if she wants to go long on 50,000 contracts, she needs to find 50,000 people that are going short. And this can be done by a matching algorithm that very much resembles your typical order book. Now, one thing that is extremely important in BitMEX and that has continued to be important in subsequent derivative exchanges is that BitMEX allows for leverage. What that means is that let's assume that Alice wants to bid, say, 1 Bitcoin. She doesn't need to have 1 Bitcoin in her custody to be able to make that bid. All she needs is 0.01 Bitcoin, a cent of Bitcoin, if you will, and say that she wants to leverage the trade by 100x. Now, that sounds great, but it's also extremely risky. If she's right, she's going to make 100 times her initial investment. If she's wrong, though, she's going to lose 100 times what she initially invested, which means that she might get liquidated, meaning her funds may get depleted very, very quickly. If Bitcoin works ever so slightly in her disfavor, she might just lose her shirt in the process very quickly. So with that, we looked at 3 different sources of data to understand what was going on BitMEX. We look at the blockchain, and that's important because that allows us to see those accounts that are on the BitMEX platform. We looked at something called the Trollbox, which is essentially a chat room that is linked to BitMEX where people boast about their exploits or lament the fact that they've lost money. And we've looked at trading data that the site itself, BitMEX itself, provides. Combining those elements, we found the first few results that are as follows. First, BitMEX really thrived in 2018. What happened in 2018? Well, this graph shows you what happened in 2018. The Bitcoin price went from $20,000 plus to $5,000-6,000. So it was what's called a bear market. You really wanted to be short. Until BitMEX appeared, it was not impossible, but it was very difficult to short Bitcoin, to bid against Bitcoin. With BitMEX, it was very easy. You just went short on those contracts and you were able to say, no, I want to bid against Bitcoin, which resulted in this very significant uptake in BitMEX users in 2018. The second thing that we saw is that we saw a migration from less funded accounts to more funded accounts. In other words, the rich get richer, the poor get poorer. Initially, we saw a fairly even distribution in terms of assets held in classes of accounts with less than 1 Bitcoin, less than 10 Bitcoin, less than 100 Bitcoin, and more than 100 Bitcoin. But as you can see in this picture, the balance is shifting over time, and as there are liquidation events, as there are reallocations, this seems to really favor the largest portfolio holders. Looking at the blockchain, we were also able to do some clustering, and what we figured out is that sophisticated traders, those large portfolio holders, tend to use multiple accounts. This is interesting because that's a very different behavior from your small retail level holder that is typically just going to have 1 account. And finally, another important result is that BitMEX traders are unusually time invariant. So if you look at the number of Trollbox commands per hour, you would expect to have a fairly uniform distribution in English because it's kind of an international language. It spans pretty much every time zone. Korean, though, is very interesting. There's certainly a lot of Korean people who live outside of Korea, but it's still a language that is, whose speakers are 95% concentrated in one time zone. And what that means is that if you see a somewhat even distribution of messages in Korean throughout the day or the night, that means that those traders are active 24/7. And that's not good. That is a sign of, compulsive behavior, gambling-like behavior. And it's not restricted to Korean people. It just so happens that We saw this with Korean because there's kind of a direct match to a given time zone, but this is basically something that we saw on the platform as a whole. BitMEX is also notorious for large liquidation events. I refer you to the paper for that. We discussed them at length. But basically, those are events where people lost a lot of money. And this actually resulted in the spot price also either tanking or gaining significantly, mostly losing significantly. Whenever there's a liquidation, if I were a betting person, I would bet very frequently that this happened to somebody who doesn't have a lot of money. And in fact, what we see is that the vast majority of liquidations occur on small positions, which again jives with the result that I was giving you earlier, which is that the rich got richer and the poor got poorer. People with a lot less money tend to lose. So in summary, cryptocurrency trading is really not for the faint of heart. We've seen that trader account wealth has become more concentrated over time. Essentially, the large institutional investors or the very rich investors have been taking the smaller retail level like investors to the cleaners. And we've also seen disturbing evidence that a lot of those traders appear to be compulsively trading day and night, doesn't matter what time of the day, doesn't matter what time of the night, which is not really something that seems to be very healthy. I'll conclude by giving you a link to our paper, which is on my webpage, and as well as this website, cryptotrade.cmu.edu, on which you can go and you can interface with the data and play with it, and it's got a lot more details. So with that, I thank you, and I'm very happy to answer your questions. Thank you.
So I have a very, first of all, this is a very interesting talk for sure. I'm very interested in this. And one thing I want to ask about is some technical question. So you actually merged this very interesting on-chain data, Trollbox, and also BitMEX trading data. But as far as I know, we cannot see how people trade in BitMEX, right? So because most of the tradings are happening in the exchange and they are not recorded. So when you say you merge this data and also probably this Trollbox as well, so we don't know that whether some specific individual who writes something trade differently or trade in this way, right? So when you say you merge this data, can you please be a little more clear about what you can do with this merged data? Whether we can actually study the individual investors' trading behavior or something?
You are correct that we cannot see on the blockchain the trading activity on BitMEX. Right. The blockchain is useful to see which money is coming in, which money is coming out. So this is giving you essentially the balances of people when they are cashing out. To get the data on BitMEX, BitMEX has an API that actually gives you access to those trades. So you can see the internals from their data. And that's how we were able to see it. As for the Trollbox, yes, you cannot check what people are typing. I mean, I could claim to have made a lot of money when in fact I lost. But there are some automated accounts, notably a Rect bot, that was actually posting liquidations in there. So we could see, and that account was run by the BitMEX service. So we could see, for instance, Donghua's account got wrecked. We know that you lost all of your money. And we can correlate that with what we see from the trading API.
Oh, I see. Yeah, that's very interesting. Thank you.
So thank you very much. It's a pleasure to be here in UBRI Connect 2021. My name is Jefferson. I'm an assistant professor of finance at FGV in Brazil. And the presentation is called Characteristics and Motivation of Crypto Investors, Evidence from Brazil. So cryptocurrencies are increasingly popular among emerging market economies, right? And there are several reasons for that. Sometimes you have a higher risk of hyperinflation episodes, you have capital controls, you have political risks. So there are several extra additional risks that investors might want to hedge or to protect themselves from. And however, there is little known on who are the crypto investors, their knowledge of this asset class, their motivation, and how they perceive risks and opportunities. So this research project seeks to fill this gap by applying a questionnaire survey on Brazilian investors. This is an ongoing research. It's in the early stages. I have preliminary results to show and discuss. And from an ethical standpoint, we got approval from the Ethical Compliance Committee from the university. So all participants, they consent to participate. They are aware of the risks and the benefits and costs of participating and things like that, okay? Our questionnaire is divided in 3 parts, okay? The first part is the characteristics of the participants. So things like gender, age, and risk profile. And then we move to the second part, which we want to understand investment, divestment, and why not investment decisions. Okay, so we ask the participant whether he or she has already invested in cryptocurrencies. So if he or she responds yes, he or she follows one path. Otherwise, he or she follows another path in the questionnaire. Okay, so we want to exploit different features. And among those that invested already in cryptocurrencies, we want to know if they keep investing or if they divested. Okay, so we want to understand these 3 kind of groups: investing, divestment, and why not investing decisions. And finally, in the third part, we want to understand the preferences of investors on how to invest. Things like purchasing directly cryptocurrencies or throughout an ETF, actively versus passively managed mutual funds, and investing only in Bitcoin or in a basket of cryptocurrencies and things like that. Of course, we have self-selection bias concern, okay? We mitigate it. Of course, those that are enthusiasts of the crypto ecospace, they're more likely to answer our questionnaire than other people, right? So we try to mitigate self-selection bias by sending the invitation to participate in the survey throughout partnering investment offices. Okay, so we have, as of now, 5 different investment offices that support this project. We have 2, at the end of the day, we have 2 subsamples, crypto and non-crypto investors, okay? So to show some preliminary results and discuss, first I will start with the typical respondent is a male, from 30 to 39 years old. Regarding educational background, he doesn't have a finance or economics or related area major. Instead, he is a self-learning guy. And our investment suitability says that the risk profile is a risk lover, risk aggressive person. Okay, so this is like the typical respondent of our survey from February to March 2021, and we got 576 respondents. And then I will discuss briefly 2 interesting features. I guess it is interesting. The first one is recognizing cryptocurrency abbreviation. So it's kind of a test of basic knowledge about the three of the major cryptocurrencies, and BTC, ETH, and XRP. So in a list of different abbreviations, we want the respondent to select which ones correspond to a cryptocurrency or a crypto token. Okay, and the result is that around 76 to 77% of the respondents could correctly identify BTC as Bitcoin. But only 16% of them correctly identify all the 3 cryptos, Bitcoin, Ether, and Ripple, XRP. And so this is kind of somehow not a high number. And 23% of the respondents couldn't identify any of the cryptos, okay, not even Bitcoin. Of course, there is a lot of heterogeneity. Respondents from 20 to 29 years old, they're more likely to correctly identify all cryptos. 60 years or more are less likely to recognize all cryptos, okay? Those that have a major in finance, economics, or related area are also more likely to correctly identify. And also those that are suitability profile mapped as a risk lover individual, okay? And the second feature I want to exploit briefly here is the allocation of an additional unexpected cash income. So where would you allocate among several asset classes? Okay, so the first option is stocks. The second one is private fixed income securities. And the third one is cryptocurrencies. So cryptocurrencies in the aggregate level is in front of foreign fiat currencies, commodities, and even local government bills or bonds. Okay, and investing an extra cash in cryptocurrencies is more likely among those that are plausibly more knowledgeable among these asset classes. Those that correctly identified all cryptocurrency abbreviations are more likely to invest in cryptocurrencies. And also something interesting is that those that are pessimists regarding the prospects of the Brazilian economy, those are more likely to invest this additional cash inflow in cryptocurrencies. So as conclusions, this is an ongoing work, a lot of information to analyze. We intend to write a paper, so we have a long way to go. This is probably the larger, more comprehensive survey of crypto investors in Brazil. To exploit the time series dimension, we want to apply the survey yearly, okay? And, okay, any doubts, suggestions, or comments, please email me. The email is right here in the presentation. Thanks again, and I'm open to hear any questions.
So I have a very simple question. So I think this is what you're doing is quite ambitious and interesting, because I haven't seen any like systematic survey that tries to track down the investors' like responses to the survey at the end of every year. That's what you're planning to do, right? But one thing is, I think this is very interesting and ambitious, but I wonder what kind of economic question that you are going to answer. So what kind of like big economic question that do you have in your mind to answer through this survey result?
Okay, thanks. Great question. Yes, the research is still in its early days, but I think we have interesting economic question to address in this project. Perhaps the first one is to identify if there is systematic differences in the perception of risk and opportunities between crypto and non-crypto investors, how they feel, what attracts and what repels them from investing. I think that's interesting from the behavioral point of view and decision-making point of view. Of course, we haven't done any conditional analysis yet, but for example, one interesting thing to check is conditional on risk propensity. Perhaps age may affect the perception of risks and opportunities of crypto investor. Is there an age effect, a generational effect on the crypto market, or educational? And there is a spoiler at this point. We're now looking at this result, but it seems that those that are self-study information regarding this market, they don't have a finance or economics background. They're more attracted by past historical performance, and those that have a financial and economics background, they're more attracted by the future, the potential of the technology in the long run. Okay, so we kind of want to explore these differences. And finally, we have an experimental analysis. I didn't talk about it here, but we intend to test some social learning hypotheses and on behavioral finance. We have a treat and a control questionnaire. So in the treat control, we show some information regarding, for example, a prominent investor that entered the crypto space, diversification benefits, news on this market. And our hypothesis is that the unsophisticated, low-knowledge investor may be sensitive to the information we review in the questionnaire. Perhaps this information changes the propensity to invest in cryptocurrencies and all their perception on this asset class. Okay, thank you everyone for watching us, and I hope you have a great conference. Okay, see you.